What's up, everybody? My name is Demetri Kofinas, and you're listening to Hidden Forces, a podcast that inspires investors, entrepreneurs, and everyday citizens to challenge consensus narratives and to learn how to think critically about the systems of power shaping our world. In this episode of Hidden Forces, I republished the audio from a Twitter Spaces event that I hosted earlier this week, headlined by Brent Johnson and Michael Cow, who were later joined by Michael Nicolas and Michael Howell. Brent is CEO of Santiago Capital and the author of the dollar milkshake theory, which we delved into during his previous appearance on the podcast for episode 250. Michael Cow is CIO and portfolio manager of Cow Family Offices and is well known for coining the, quote, dollar wrecking ball as a similar metaphor for describing the dynamics of dollar hegemony. Michael Nicolas is a macro investor and the founder and former CIO at Apple Tree Capital. And Michael Howell is the CEO of Cross Border Capital and a regular contributor and active member of our Hidden Forces Genius community. The purpose of this conversation and why I convened the panel is to help advance our understanding of the dynamics of dollar strength, something that has befuddled many analysts and which runs counter to common perceptions of how currency and sovereign debt crises unfold. It turned into a very lively discussion about a topic that has become increasingly relevant in recent months, as the US dollar has appreciated dramatically against a basket of international currencies, from the pound sterling and the euro to the Japanese yen and the Chinese yuan. Because of the dollar's outsized role as a global funding currency, dollar strength often translates into foreign weakness, not just for other currencies, but also for their respective economies and asset markets. The consequences of a further strengthening dollar, how long it can continue, and possible endgame scenarios for economies and governments are all topics that we discuss. For anyone new to the program, Hidden Forces is listener-supported. I don't rely on advertisers or commercial sponsors, which is why the second hour of our conversations is normally available to premium subscribers only. If you want access to our full episode library, as well as the transcripts and intelligence reports, which include my takeaways from every episode and my thoughts on what comes next, head over to hiddenforces.io, select the episode that you're interested in, and click on the premium extras, where you can then sign up to one of our premium content tiers. If you have questions about our Genius tier, which includes access to the Hidden Forces community, Q&A calls with guests, in-person events, and dinners, feel free to send an email to info@hiddenforces.io, and I or someone from our team will get right back to you. And with that, please enjoy this lively and engaging conversation. So guys, let's start off first by clarifying what we mean when we talk about the dollar milkshake or when we talk about the dollar wrecking ball. What is it fundamentally about the dollar system that each of you have described in your own particular metaphors that explains its strengths? In other words, what is the common dynamic that you are all speaking to?
Well, first of all, thanks for having me, Demetri. I'm glad you did this. I think it's rather timely as what we've seen go on in the markets over the last few months, and I guess really year to date. To really break it down in a very simplified manner, the dollar milkshake is really nothing more than a framework for how I see a sovereign debt crisis and a sovereign currency crisis playing out. At its base core, what it says is that over the last, call it 10 to 15 years, as we've gotten into these, financial crises that got these perpetual crises, the solution has been to borrow more money, kick the can down the road, print money, for lack of a better way of saying it, and pray for a brighter day in the future. And so the whole world has, quote unquote, mixed this milkshake. But for a number of reasons, based on the design of the system, whether it's fair or not fair, whether it's moral or immoral, the simple fact is that the US dollar has several advantages that none of its competing currencies do. And as a result, as this milkshake gets mixed in order to combat these financial crises, I believe the US is the only one that has the straw, or at least has the biggest and the best straw, and will therefore drink that milkshake that the rest of the world is mixing. I don't think it's so important who prints the money. It's more important who captures the money. And I think, again, for better or for worse, I think the U.S. dollar and the U.S. markets are going to capture most of the capital that's being provided.
Before we go to Cal, I have one more question, Brent, which is when you say capturing, what matters is who captures the money. It's not as important who prints it. What do you mean?
Well, so this is where it starts to get a little confusing when you use terminology, because, we could probably spend 2 hours, debating whether or not any money is actually printed or not. But just to keep it very simple, let's just use the term money printing. The central banks, provide liquidity, print money, do stimulus, however you want to describe that process. And what I mean by capture it is that I think, in many ways, capital that is able to move will seek out where it is treated best. And for better or for worse, I think capital will be treated best in the United States. Now, I want to be clear, that doesn't necessarily mean that it's treated well. It's just treated best. It's a relative game here. And I think as we get further into a crisis, because the world needs dollars and because the system is designed to favor dollars over other currencies, I think capital will flow into the dollar at the expense of other currencies. And I think that liquidity will flow to the United States. And when it flows to the United States, it will deprive the places that it's leaving of that liquidity. And it will become a self-reinforcing doom loop that will squeeze the dollar higher. That's the thesis. Now, whether it will play out, I don't know for sure. I have a high degree of confidence, but nothing is ever certain. So, but that's what I mean. I mean, the U.S. will be seen as a relative, a safe port in the coming storm.
Great. So we'll get into that as the discussion progresses. So, Michael Cow, why don't you jump in here? You are the author, as we said, of The Dollar Wrecking Ball, a much more aggressive thesis, though it describes, I think, a very similar dynamic. What are you capturing in your description of the dollar system, and how does it similar to Brent's? What are the differences, and how would you describe it?
Sure. Thanks a lot for doing this. I've been looking forward to this discussion. And Brent and Michael, Nicolas, and we've all spoken separately offline about this. But I find it interesting that each of us have come at it from slightly different angles, but yet kind of arrive at the same place. So I started my career in macro and then spent most of my career in micro, and micro meaning, in the world of capital structure and reorgs, bankruptcies, et cetera. And since the bear market in oil of around 2015, I've been very, very enmeshed in the oil space and getting to understand the nitty-gritty fundamentals of it. So I'm approaching this dollar wrecking ball from a very commodity, specifically oil-centric perspective, because in the beginning of 2021, I wrote a number of threads talking about how the combination of a number of factors, long-term capex starvation for years in the oil space, plus this hell-bent for leather ESG mandate, and exacerbated by Ukraine, Russia, et cetera, have conspired to create this very, very structural inflation that originated in oil, but then has leapt into now much stickier components. In the middle of 21, I also got into a number of, that's really when I started my sort of Twitter adventures, and I got into a number of debates online about how, about the dollar, implications on the dollar, and how, this sticky structural inflation originating in oil would create an aggressively hawkish Fed, well ahead of the rest of the world's central banks, and in turn create, that's when I first started using the word, dollar wrecking ball. And here we are. I think there's a lot we can talk about, but the determinants, where I agree a lot with what Brent says, the determinants of a currency's value are manyfold, right? It's first of all, it's a relative value. Despite years and years of money printing and an overt weak dollar policy, right? If you want to talk about insults to the dollar, our Fed has done it with the aggressive, 5 to 6 trillion of balance sheet expansion plus aggressive MMT. And yet during that process, you saw the DXY basically go no lower than around 90. The reason is because other central banks were doing the same. So I call the U.S. dollar the least dirty shirt, right, amongst the bunch. And then we can also talk about, I know that we can also talk about some of the geopolitical factors, right? So it's not just a matter of debt to GDP that guarantees the safety and soundness of a country's currency. You have to also look at the left side of the balance sheet, the sovereign balance sheet, looking at natural resources, geographical advantages, military, hard and soft power advantages. So all of these things I encapsulated in a thread about how this, back in May of last year, when Bitcoin was all the rage, and people were talking about Bitcoin being the solution to the end of dollar hegemony. And I said, well, not so fast, because I think all this talk about, the US dollar going the way of the Reichsmark ignores so many other factors. So I guess I'll leave it there for now.
That's a great summary, Michael. And it's easy to forget. I've forgotten all those J. Powell money printer go burr memes that were so popular, making the rounds on the internet during that period. So let's go to Michael. Nicoletos, we're going to call you Michael number 2 for this Twitter Spaces. So why don't you introduce yourself? Unlike with Brent and Michael, I didn't give you a formal introduction. Please make sure to introduce yourself. Tell us a little bit about you, and then talk to us about where you come to this dynamic from. Like, what's your perspective? How do you tackle it?
Hi, Demetri. Thank you for having me. It's a pleasure talking to you and to Brent and to Michael Cow. As Michael said, we've been speaking a lot offline, and with Brent, we've known each other for quite a few years. I spent the last 10 years being the CIO and co-founder of Appletree Capital, which was running a long-short emerging market fund. So I spent most of my life looking at emerging markets. And when you spend your life looking at emerging markets, you spend a lot of time looking at currencies. So a few years ago, actually, speaking to Brent, who was telling me about his milkshake theory, and something clicked. And it clicked because when you're an American or you live in the States, you tend to see the world through the US dollar. And when you look at the world through the US dollar, you feel that the US is doing a lot of things wrong, which it is, but you fail. Most people fail to see what the other countries are doing wrong. So having spent a lot of time in emerging markets, I could understand what the effects of the dollar could be on other countries. Now, being a European as well, and having seen the European crisis and having seen what is going on right now, it's pretty clear for me, and to steal Michael Cow's line about the cleanest shirt, which I share this view. The US, even though it's not a clean shirt, it appears to be the cleanest shirt, which means it's, let's say, in a lot less, there's not so much trouble in the US dollar versus the other currencies. Now, if we go to the world we live in today, we see that the main theme tends to be inflation. And inflation is a fact, but not each country faces the same issues when we talk about inflation. When we talk about inflation, it's not the same thing about every country. So for the US, there's a demand side inflation, which is, the labor market is very tight. So there's a lot of demand, but there's also a supply side issue, which is the energy crisis. And when we talk about the energy crisis, people think about the energy as a standalone problem, but fertilizers use a lot of energy. So that means higher food prices. And what's the problem with higher food prices and higher energy prices? These are both inelastic goods. So it's not like you can live without them. You might stop having another drink, or you might not buy a second shirt, but you'll need energy and you'll need food. So when we go to Europe, for example, or we go to Japan, or we go to the UK, and commodities are priced in dollars, and you get a supply shock like the one we got, it means that the inflation you get in the rest of the countries is more supply-sided because the economy, the labor market is not that tight. So the demand side is not that tight, and the supply side has just got a shock, which is a supply shock. So monetary policy is really effective when inflation is coming from the demand side. When it's coming from the supply side, you face a serious issue which the monetary policy can't really fix unless it crashes demand. And to crash the demand, it takes a big downturn for the economy. So the US is raising rates to fight both the demand side of its inflation problem. It raises the value of the dollar, and all the rest of the world is chasing the US in order to keep their currencies from falling and reducing the import pressure of inflation. So right now, the way the world is structured, and Brent is actually really good at explaining this. He's been on it for a few years, and I have to say he's been early, but he's been there, and he never changed his view. And this is, really admirable, even though it wasn't working. His thesis wasn't working for him for a few years, but he kept on saying that this would happen. And having been there, I can say this is a very tough to keep your position and not change your mind, even though if markets are going against you. So the structure of the world right now is favoring the dollar. And as the Fed raises rates, everyone chases the Fed. And this creates a vicious loop, which is self-reinforcing.
Can I say something real quick to what Michael Nicolas just pointed out?
Go ahead. Sure.
So what Michael just said about especially EM countries or any countries that are dependent on energy, I think that's a very critical component of this, because last week we saw the PBOC intervene to actually strengthen the yuan, which had been weakening precipitously throughout the year. And that, I think, is a tell on just how worried China is on inflation. Because when you think about China's economy, it's an export-driven economy, right? And they are very dependent on their current account surplus. So one would think that if their economy is on the back foot, given the property crisis, the zero COVID policies, and the fact that all of their neighboring countries have devalued currencies, that they would jump at the opportunity to allow the renminbi or the yuan to weaken. But instead, they did the opposite. So to me, that really is a tell on how worried they are about importing commodity inflation.
So guys, a lot of things were said in the course of the three of you speaking separately, and I wrote down some notes. And I'm thinking, let's go to this one first, something that came up in my mind while I was listening to Brent talking, which had to do with the source of dollar strength. How much, and in trying to understand really what is it that maybe people have a hard time understanding about the source of dollar strength, how much of the dollar's strength is endogenous? It is an outgrowth of the structure of the system and its place within that system. And how much of it is exogenous, factors having to do with America's maybe role in the world or the bounty of its economy, or its capital account, its current account, etc. How do you guys think about that? Whoever wants to take a stab at that first, go ahead.
Well, I'll jump in here. This is Brent. I think it has a lot to do with it, Demetri, and I can't put a percentage on it, but I would say not all of it, but 70 or 80% of it, I think, has to do with the structure of the system itself. And then I would put another big portion on the U.S., as the global hegemon, putting pressure on everyone else to keep the system as it is. And what I mean by that is the basic design of the system basically ensures that the US dollar will fall last. Now, the only way that the US dollar is going to fall first before these other currencies is if the Fed or the Treasury or the US government in general all got together and agreed that overnight we are going to devalue it just unilaterally, right? In which case the dollar falls versus all the other currencies. I don't think we're anywhere close to that happening. But anything outside of that, the structure of the system almost ensures that eventually we will get back to right where we are now. And, kind of a follow-on to that is that there's a lot of people who have said, well, the dollar will fall when the Fed pivots and goes back to QE. And that's probably true. QE would probably put a dent in the dollar's rise and maybe even make it fall, right? It'd definitely be a headwind and probably make it fall. But, to Michael's point at the beginning, look at everything they did between 2020 and 2022. I mean, they threw everything at it. And yet here we are at a 20-year high, right? And so the point I want to make is that until the system is completely redesigned, we will end up right back where we are today. Now, I don't know if it will take 6 months to end up back where we're at, or if it will take 6 years to end up back where we're at. But until the system is reset, until all the debts are wiped off the table, the system design basically ensures we end up back where we are. And then the second thing I would say regarding, you said regarding the U.S.'s role in the world, is this system favors the United States. And it kind of goes to what Michael Cow was saying about you can't just look at the liability side of the balance sheet. You got to look at the asset side of the balance sheet. And then you can't just look at the supply of currency. You have to look at the demand for the currency. So the system design ensures there's more demand for the dollar than there is for any other currency. And then the U.S. roles as a global hegemon and the global military power ensures that if anybody gets out of line, they can very either nicely or very not nicely encourage them back in line, right? And every now and then somebody tries to, take them on and escape the system. And it works to varying degrees, but in the last 100 years, it's never worked, totally. And until the whole world gets together and decides that we are all at the same time going to leave the system and move to another system, and they're willing to fight a war to do it, the U.S. is going to keep the global reserve currency. And I'll just do one little add-on to that, and then I'll be quiet and hand it off to a couple of the other guys, is that in the last year, since the dollar started to rise again, first of all, QE was going to solve everything, and the dollar was going to be debased, and the rest of the world was going to rise versus the U.S. When that kind of started to go by the wayside, then this new theory kind of popped up that the U.S. it no longer benefited the U.S. to have the global reserve currency. In fact, it was no longer an exorbitant privilege; it was becoming an exorbitant burden, and therefore the U.S. would prefer to lose the global currency or the global reserve currency, and perhaps give away some of this power and the burden that came with it. And the problem with, and part of the burden there was an economic burden. And so they said for these economic reasons, it would benefit the U.S. to change the structure of the system. The problem with that is global reserve currencies are not about economics. I mean, they sort of are, but they're really about power. They're really about enforcing your will on the rest of the globe. And I know people don't like to hear that, but if you really get down to the real politic of it, that's the way it is. It doesn't really have to make sense. It's kind of like when you're a kid and you do something and your parents don't want you to do it, and you say, why not? And they say, because I told you to. And you say, but what's the reason? And they give you some stupid reason that doesn't make any sense, but it's still the way it is because they're the bigger, they're bigger and they're more powerful than you. And, you know, as a kid, you just kind of have to live with it. And that's kind of how the global reserve currency is. It doesn't always make sense. It's not always the most efficient. It's not always fair. It's not moral, but it's the way it is. And it's the way it is because the U.S. is the most powerful, entity on the planet. Now, that could change someday. And when that happens, then maybe the rules will change. But as of right now, that's kind of the way I see it.
I love that metaphor. So this is a question for all of you guys again, but maybe Brent, you can take it first if you want. If you think you can be concise. I just want to manage everyone's got such great comments to make. But I wonder if people have the order of operations wrong in their macro frameworks. So many investors and so many commentators in macro when it comes to where markets are situated within the political system itself, situated within the national security paradigm, because they've been living within a very anomalous period in human history during a unipolar period where the United States guaranteed security for almost every country in the world, with the exception of a few rogue states. And so the appreciation for the primacy of politics and where power is situated in all of that maybe doesn't exist for a lot of folks. I'm curious what you guys think of that. The fact that we are now in this phase of transitioning manifestly, it's undeniable that unipolarity is not the world we're living in today. And that just is obvious based on the geopolitical challenges and ruptures that we're seeing in the world. Do you guys think that dynamic, that shift from unipolarity to multipolarity or maybe to a new bipolarity is something that's messing with so many investors' models because they grew up in a world where all they knew was the neoliberal international order?
I'll take a stab at that. I liked how you framed it originally where, the sources of dollar strength, are they endogenous or exogenous? And I would say it's actually both. So let's break down the endogenous sources, right? So as Brent said, there was, after World War II, there was this Bretton Woods one, where essentially the overlords decided that this was going to be the new world order. But since then, I would say that the market has chosen to keep the dollar primacy. It's not as if there's behind closed doors that the overlords are still trying to prop the dollar up and against the market's wishes. The market has chosen the dollar system because of its unrivaled liquidity, adoption, underlying depth of bond market liquidity, which is another key importance. And all of that in turn stems from geopolitical advantages. To borrow Peter Zeihan's phrase, he called in 2014, he wrote a book called The Accidental Superpower. He calls the United States the accidental superpower because despite all of our, I guess you could argue, bad policy choices on the world stage, ephemeral presidential cycles that lead to inconsistent policies from one administration to another, we've become an accidental superpower by dint of our unrivaled geographical advantages. So you can break it down into a number of categories. Our river networks, our bicoastal oceanic buffers, just on arable land. Here's an interesting stat for you. Our arable land per capita is 15 times that of China's. So how do you put a relative price on that? How do you put a relative price on the relative hard and soft power? So these are all factors that go into a very complex calculation, well beyond simple debt to GDP metrics and even interest rate differentials. So let's talk about interest rate differentials for a second, because that's what kind of drives the exogenous source of current dollar strength, which is, I would say, is a more cyclical thing. So from what I started with the commodity angle, it's interesting that, usually in the past, people have associated, oil strength with dollar weakness. But this time around, I note that this bout of dollar strength stemmed from commodity strength to begin with. And the reason why there is a U.S. dollar wrecking ball is our Fed is now ahead of the cycle. We were ahead of everybody else in the world in terms of easing and heaping loads and loads of liquidity into this COVID environment. But now we're the first to emerge out of it. And from an economic relative strength perspective, there is no major economic region that can compare. So, even though nothing moves in a straight line, and it's debatable whether or not we've seen a local high in the USD, DXY, I would say that the real test for when we see a high in the dollar is when you come at a point in time where the other major regional blocks, economic blocks, are comparatively weaker than the United States economy, that allow their central banks to essentially out-hawk the Fed. And right now, if I'm looking at the Eurozone and the ECB, or Japan with the BOJ, or China with the PBOC, all of them are in far weaker relative positioning to the dollar. So I think that's my answer to your exogenous question.
Great. And Michael N., you've been sitting there patiently. Feel free to respond to anything that we've discussed so far.
Yeah, sure. I was listening carefully to what my predecessor was saying. It's very interesting, the point you made about unipolarity and multipolarity. I think the world, or the rest of the world, is trying to go to a multipolar system, but trying to do that, it means that they're trying to change, let's say, quote unquote, the benchmark. The reason that the dollar is so popular is not only because the US is 25% of global GDP. It's also because it has the most liquid financial market. You can raise capital easily. You're very liquid. You can raise a credit as well. So you can switch from dollars to any currency at any moment. You can buy dollars. You can sell dollars. So the fact that the economy is so open gives it's a sign of strength, not a sign of weakness. Because if it was the other way around, then the PBOC would probably be the strongest currency out there. Now, the US is 25% of global GDP, but it's 87% of global trade. So when everyone needs the dollar to trade, and you can see that from commodities, which is pretty clear, everyone's settling in dollars. There have been some exercises and some attempts to trade in other currencies, but this is a very small amount in terms of percentage versus the total amount traded. You see that everyone wants the dollar. Now, the thing is, having been an emerging market fund manager, I've seen what emerging markets do. And what do? They borrow in dollars. Why do they borrow in dollars? Because the interest rates in their local currency are so expensive. So they go to the US dollar, which is a liquid market. It has lower rates, and they can borrow at these rates. So this happened on a global scale. And as the dollar strengthens, this means that all these countries and all these corporations in these countries need to repay these dollars at the more expensive FX rate, and they need to pay a higher interest rate because interest rates are going up. So they have a double whammy when it comes to their interest payments and their interest debt. So this thing is a self-reinforcing loop. And to go back to the earlier points regarding if it's an endogenous or an exogenous, everyone who watches the US comes out and says the Fed is monetizing the debt, the Fed cannot fund the US deficit, and so on. But if you look at the rest of the balance sheets, The BOJ is around 120%, 128% of Japan's GDP. The Eurozone is 81% of the Eurozone GDP. The Bank of England is 39%, and the Fed is 35%. So if you are the biggest economy in the world, everyone wants your currency. Everyone trades in your currency. And your Fed has only 35%. Only is a relative word in this discussion, you understand? and you have only 35% is owned by your Fed. Actually, you've not monetized so much debt versus other people, versus other central banks. So I think that talking about the dollar, we tend to focus on the bad things, but if you go specifically and check all the other, especially the developed economies, you'll see that the central banks' balance sheets are in a worse position than the US. You see that everyone wants to trade in US dollars, and this hasn't changed. So as we speak, the structure is still the same. A lot of countries try to go to a multipolar world, but they find out that when they try to do that, their currencies start to fall, and then they're facing serious problems. So I'm not sure this attempt will work at this stage. It could work someday, but I think the more they try, the higher the friction will be, and that friction will cause at some point something to break. We've seen a few signs the last 20 days, 10 days actually. The BOJ intervened, the BOE had to intervene. And I think these are only the first signs. We're going to see more issues such as these in the future, unless, of course, the Fed pivots, which I tend to agree with Brent, that I don't believe that this will happen anytime soon. Although history suggests that whenever the ISM number in the US goes below 50, the Fed either pauses or pivots. I think at this stage, the way things are and what the Fed has communicated, they want the US economy to slow down. And I think as they overdid it in QE, they will overdo it in raising rates. So I think we're going to see the same way of doing monetary policy. And again, the Fed will be criticized if it stops early. If it stops late, they will switch. So I don't think it's easy for them to stop early and say, yes, we believe we've done enough. They need to see the number come down, the inflation number come down before they stop.
Yeah. Hey, Demetri, let me, before I forget, Michael, I want to piggyback on something that both Michaels talked about with regards to the potential for a move from unipolar to multipolar. I want to be, it's not that we don't see it, and we've all three of us, we've discussed this. It's not that we don't see the attempts. It's not that we don't believe there is a desire to do it. The fact is it's much easier to talk about doing it than actually doing it for a couple of reasons that I don't think we've talked about yet. And part of it is the amount of dollar debt that is out there in the world. Everybody knows about the US dollar debt is like $30 trillion, and unfunded liabilities is probably multiple $100 trillion. But the fact is there's a euro dollar market out there, which is dollars that exist outside the United States. That's probably bigger, or actually it is bigger. The euro dollar market is bigger than the domestic US dollar market. And so then a lot of people will say, well, why don't the rest of the world just default on all of these loans that they have, and then there won't be any demand left for the dollar? Well, the problem with doing that is that they would not be defaulting on the United States. It's not the United States that lent the euro dollar market all this money. I mean, they lent them some of it. But the fact is that the euro dollar market lent other people in the euro dollar market all this euro dollar debt. So if all this dollar debt that sits outside the United States gets defaulted on, they're defaulting on themselves. So this would be like if you're living in New York City and you have a bank account with dollars, and you get transferred to Hong Kong, or you get transferred to Germany, and you fly over to Germany and you rent an apartment, and now you got to use euros. Well, you don't just destroy your bank account over there that has dollars in it, right? You want to convert those into something else. You wouldn't just burn them and let them go to zero just because you're not going to be using them anymore. But that's what the euro dollar market would have to do. Yeah, they would get rid of their dollar debt, but it'd be like if you found a bunch of black mold in your house and you had to get rid of the black mold. Yeah, you get rid of the black mold, but you got to burn your house down to do it, right? So it's easy to talk about, yeah, let's just do it. But when it actually involves you losing assets in the process, it's much easier or it's much harder to pull off. The second thing I would say is that there's, earlier this year when the U.S. quote unquote weaponized the dollar and seized Russian assets and, froze bank accounts, there was a big uproar. I'm really not sure why. I mean, this has happened before in history, but there's this big uproar that the rest of the world would no longer trust the dollar and they will go elsewhere because this is just immoral and, the wrong way to behave. And I would say, again, it makes a lot of sense, just to say that, but to actually do it is something different. And the example I'll give is we're hosting this call right here on Twitter. Now, in the last year, Twitter has canceled people. Twitter has denied freedom of speech. Twitter has, shadow banned different people. And so we're still all here though. And the reason we're here is because this is where the action is. This is where the social media liquidity is, right? And so it's one thing to say, yeah, we wish it wasn't this way. Yeah, we wish it was a little better. But where else are you going to go? And it's just not that easy. There are competing social media platforms that we could all go to. But the reason we don't is there's just not that many people there, right? This is where it's at. And it's hard to get everybody to migrate to a different system. Now you can get a few here and there and you can get a bunch of big announcements and, Trump can say, I'm leaving Twitter and I'm going to go start my own thing. But, look at the relative size. It's just very, very hard to transition.
Yeah, I just want to say one thing real quick there, maybe a couple of things. One is, so a great example is Russia's inability to pay debts, dollar-denominated debts, euro-denominated debts, but let's just stick to the dollar. They went out of their way to try to pay dollar-denominated liabilities. So that's how powerful the dollar is in the international system at the same time as they were being sanctioned. And to your point, the euro-dollar market didn't grow up. It wasn't something that America imposed on the world. Foreign institutions and actors wanted to transact in dollars, and the U.S., if anything, facilitated the growth of the euro-dollar market in response to the demand for dollar usage. In terms of censorship, I think it's Michael Dooley. I was going to look for the paper, but it was too much multitasking. I think Michael Dooley and other authors authored a paper some years ago that looked at the benefits of censorship to running the global reserve currency. That, in other words, some level of censorship, some level of the ability to impose sanctions is a feature to a system like this, not a bug. So that is, I think, also speaks to your point. Cal, were you going to jump in? If you want to, go ahead.
Sure. I wanted to riff on a couple different themes, but first I wanted to talk about what Brent just said about the weaponization of the dollar. And again, it comes back to relative advantages and disadvantages because, people, I find it kind of funny that a lot of the reasoning behind Bitcoin and crypto adoption is network effects and Metcalfe's law, et cetera, et cetera. Well, you want to know what has the ultimate network effects? It's the U.S. dollar system. And so when you talk about alternatives to the dollar, yes, there's some oil trade being conducted in between the yuan and Russia directly, between Iran and China. But let's turn the tables for a second and think about, okay, do any of them even present a remotely an alternative to the U.S. dollar as a global reserve currency. In other words, despite the occasional bad policies of the United States, I would say that generally the world would probably agree that as the sort of the benefactor, if you will, of the global reserve currency, the United States has generally been a fairly benevolent benefactor. Would you trust your reserves to be in rubles, or in the Iranian rial, or in the North Korean currency, or the Chinese renminbi? So I think it's there's a lot. It's all a relative game. The other thing that I wanted to talk about that Mike Nicolas alluded to is this differing of incentives between the different regions. And to the Greeks on stage here, you'll appreciate that I made a drink last night and I dedicated it to the Fed. I called it the Scylla and Charybdis, because that represents the choice that our Fed has right now. And it used to be that if everybody were aligned cyclically, economically, then the Fed can be the plunge protection team for the rest of the world, right? But as last week's Bank of England intervention in the gilt market showed, there are things about the current situation that make the macro setup very, very unstable, because there are differing incentives. The Bank of England had to intervene in the gilt market because of how levered their pension systems were, right? So they cannot allow longer rates to go up. In other words, they cannot allow for a bear steepening. However, because England doesn't have longer dated mortgages beyond 5 years, if they keep hiking the short end to keep up with the Fed, they're going to break homeowners. The third choice they have is they do nothing and then they break everybody through inflation, right? And so if you notice what happened, Truss had to backpedal on her fiscal stimulus for exactly that reason. England will probably see double-digit inflation if they go that route. Now let's talk about the Fed for a second. Our choices are very different, because I've been espousing this notion that the least bad option for the United States might be to bear steepen the curve. So if we bear steepen...
Can you tell people what bear steepening means, Mike, also, as you continue
talking? So a bear steepening means that longer rates go higher even as the Fed is hiking the front end. Compare and contrast that to a bull steepening, where the yield curve steepens when the Fed is easing the front end, right? So the knee-jerk response, guided by decades of easy money, is that the yield curve only steepens through bull steepening. But I have news for you, because during periods of stagflation, bear steepening is possible. In fact, I believe it was last week, both Jay Powell and Brainerd said that they would like to see all points on our yield curve to have positive real rates, and their measure of inflation being the core PCE deflator. So we're talking 4.6 to 4.8%. So they're talking about having nominal rates all along our yield curve higher than potentially 4.8%. Now think about that for a second. If we did that, it would crush demand for long-dated assets like residential real estate, which is a big component of CPI. So they kind of want to do that. They want to weaken wealth effects, but it might allow the Fed to ease up on the Fed funds rate, right? And so the problem here is that if we bear steepen, what are the knock-on effects for the rest of the world? And I think that the presence of structural inflation is what is different this time around. And it presents all sorts of problems because the presence of structural inflation creates an every man for himself dynamic where our Fed is not necessarily aligned with the other central banks of the world and don't count on our Fed to go back to QE just because the Bank of England has to do so or that the Bank of Japan has to do so. And so that obviously has implications on the US dollar as well.
So this is a perfect setup because I want to ask the other Michael a question having to do with the negative effects that tightening dollar liquidity has on some of the European countries in the context of the war in Ukraine and the national security concerns in Europe. Quick point before I do that, the paper I mentioned, written by Michael Dooley and a couple of other authors, is titled U.S. Sanctions Reinforce the Dollar's Dominance. And that's, I think, NBER. It's published on the NBER's website, the National Bureau of Economic Research. So anyone that wants to check that out. So, Michael, I'm curious, one of the things that I have talked about on the show multiple times, and I think Brent has also alluded to this, and I've seen Cal also make some similar statements on Twitter at various moments, which is that, well, what I've specifically have felt is that the Fed would be less concerned this time around about the negative impacts of a rising dollar globally because a rising dollar would have a negative impact on commodity prices and therefore Russia's ability to procure the funds it needs to prosecute its war against Ukraine during a time when really there was a great sense of urgency around trying to stall the progress they were having in their initial month of their invasion, whatever progress they were going to have. And I'm curious if, one, you agree with that, and two, if you think that that dynamic is no longer as important because now the consequences of a strong dollar have negative political implications for the Europeans. And so I'm curious what the view is over there. You're talking to us from Athens right now. Is there a threshold at which dollar strength risks undermining the economic and political stability of U.S. allies during a time when they are going into winter without a regular supply of energy? I'm curious what your thoughts are.
Well, let's start from the fact that the euro was created, and when it was created, it was supposed to become a challenger for the US dollar global reserve currency. So 20 years have gone by and this hasn't happened. And as we speak, the euro is probably in its most fragile state since inception. And the reason I'm saying this is, yes, when the dollar goes up, traditionally commodities go down. However, this is usually done when it's driven by demand. Commodity oil has gone up in Europe, especially, and most importantly, natural gas has gone. Just to put a number, in November of 2020, natural gas in Europe was around 10 euros per. I don't know what the metric is exactly, and now it's at 200. So you understand that the cost being at 200 is the equivalent of oil being around $500. So Europe imports 50% of its energy from Russia. So suddenly you have a war, you have a supply constraint, the prices go up, and that supply constraint creates inflationary pressures across Europe. Now, given that it's supply-sided and not demand-sided, there's not much the ECB can do. But the ECB is forced to raise rates in order to stop the euro from falling versus a US dollar. So Europe is between a rock and a hard place, actually, because they can't do much. And everyone, supposedly, Europe was supposed to be helping each other. And right now, as we saw today, or this week at least, last few days, Germany decided to launch a stimulus of 200 billion for itself. Now, Germany can do that. Not all countries in Europe can do the same. So suddenly everyone's for themselves. The ECB cannot stop inflation. They can only crush the economy. And if they crush the economy, yes, inflation will come down. But again, as we pointed out earlier, energy and food are inelastic goods. You need to move around, you need to eat, you need to heat your house, your home. So going into winter, these pressures will likely exacerbate and become worse. So the dollar getting stronger poses, in this case, a bigger threat for Europe because it reduces the value of the euro, and Europe has to import commodities, which, as the euro falls, the price of these commodities becomes more expensive. So right now, Europe is facing a big, is about to face a big crisis because not all European countries have benefited as much from the euro, and most notably, Italy has suffered the most, being that since getting into the euro, it hasn't seen many benefits from being in the euro. And right now, Italy is in a tough situation, as everyone has noticed. They just had elections, and we were going to see what they're going to do. But I'm pretty sure that after a certain point, Italy will not accept Germany being able to borrow 200 billion and Italy not having energy because it cannot afford to buy, or it cannot borrow. Now, let me give you another example where the problem is. As the crisis exacerbated, European spreads started to widen, meaning that all sovereign bonds versus the German Bunds started to widen. So as this happened, the ECB had to intervene and say that we'll not let the spreads widen any further. For example, in Italy, inflation is around 9%. When you cap the bond yields, and they haven't given a specific number, but let's say they cap the bond yields at 5%, it means that the investor who buys the Italian bond is willing to lose 4% in real terms. Given that inflation is 9%, the bond yield is 5%. Now, who will be the marginal bond buyer for Italy? Who will be the marginal bond? At some point, yes, initially, someone will come up and say, okay, I'm getting 5%. I used to get 0%. 5% is good. But after a certain point, when they realize that inflation is not coming down, they'll say, no, 5% is not that good. So who's going to be the marginal buyer? So ECB will be forced to start buying more and more and more. And this thing will come to a point where things will get very ugly because Germany, Netherlands, the northern country will say enough is enough. And the southern countries will say, what do you mean enough is enough? We need to survive. So there will be a political issue going forward, which we don't know how it will be resolved. So I think Europe is in a very tough spot, and things are likely to get worse before they get any better, because ECB is going to raise rates. They cannot do anything regarding demand, so they'll have to crush the economy in order to reduce demand. And again, but crushing the economy will not reduce demand for these goods so much because there are inelastic and necessary goods for everyone. So I think this thing was going to get much worse before it gets any better, for Europe at least.
Yeah, so Michael, you're on board with a secular inflation thesis. You think that inflation is here to stay and its primary drivers are going to be energy? Or I'm just curious to understand exactly what you're thinking is there, because I would like to also talk to you guys about what the role of energy policy is here and what kind of role you expect that to play and support for that, because so much of what has driven investment in the space has been mandates around climate change and meeting those climate goals. So anyway, go ahead, Michael, and then Cal can jump in.
Okay. So as I said in the beginning, inflation is not the same. When we talk about inflation, we don't talk about the same thing everywhere. In regards to Europe, given that it's a supply-driven and meaning that energy feeds into fertilizers and fertilizers feed into food prices, which are both necessary goods that we need on our daily lives. And these are inelastic goods. I think that as the war continues, the inflation will not come down in Europe unless there is a big crash or unless there's a big shock to the system. Provided that and none of these happen in the meantime, yes, Europe will keep having inflation. And even if we have a shock, I don't think you'll see inflation coming down from 9-10% to 2%. It might come to 4%. Okay, it's more manageable, but inflation will stay as is. You mentioned the green energy. I want to say that one of the big causes that Europe is in such a mess is because it decided to become green before being ready to be green. So they decided that by 2025, 2025 or 27, Europe would be green. And they thought that natural gas is green, and they would turn into solar and wind, and they would be fine. But they brought they thought this would happen much faster without even putting a plan in place. And they got so fixated with this idea that Europe became so dependent on Russia. And that's why Europe is here right now. So unless the war stops, which doesn't look likely, at least in the next few months, and unless a big shock happens in the economy, I think inflation in Europe is here to stay. It won't be easy for it to come down.
Cal, you want to jump in?
Yeah, I wanted to actually underline what Michael has been saying about how the criticality of oil in this entire debate. It all rests with oil, and as Michael alluded to, I call oil an OPEX commodity. You compare and contrast that to CAPEX commodities, like for instance copper, cement, etc., that are more based upon economic growth. Oil is an operating expense, right? So it is definitely demand inelastic in the short term. However, there is more demand elasticity in the longer term. So one thing to note is that on the day of the BOE intervention in the gilt market, you remember that we had a huge risk-on market across the board. And that day, I basically tweeted out the following. I said, the plunge protection team is back today with a vengeance, re-injecting Fed pivot hopium back into bonds and risk assets. But here's the rub, oil. If there is a real pivot, oil will moon and we will be right back to where we started. Now let's examine the risk rip today. What's interesting about today, I found, was, aside, you could talk about all the technicals and the oversold conditions and whatnot, but a new stakeholder has entered the mosh pit, so to speak. That new stakeholder is OPEC Plus, who is now jawboning, and I have my reasons to perhaps doubt the jawboning, but they are saying that they're willing to potentially cut up to 1 million barrels per day. Now, my doubts stem from the fact that I think them entering the fray this early with prices this high, especially with the Eurozone on the precipice of falling into a depression with a capital D, is not the most politically astute thing for OPEC to do here. And I think there are potential repercussions for them to do that. But if they did that, right, it would bring about what I call the structural supply and demand singularity point in oil that much closer. Let me talk about that for just a second. My base case for this whole sort of stagflationary setup is that, it started with commodity price inflation. It leapt into stickier components that are now in wages and rents, which is core inflation. And at some point, you're going to see those indicators start turning down. But I predict that even absent any OPEC cuts in the next several years, we're going to reach a point in time where, because of the lack of investment in the space, we're going to reach a point in time where even a recession-impacted demand is going to exceed global spare capacity. I don't believe we are there yet. And I can say that with some confidence because otherwise we would not have seen oil go from 130 down to the 70s. But I think we are getting close to that point. Now, so my thesis has been that throughout potentially the rest of this decade, we could see this start-stop sort of tag team effect where, just as core starts slowing down, energy starts picking back up again, and then vice versa, right? So kind of like an asynchronous start-stop between core inflation and energy inflation. If OPEC Plus actually cuts and enters the fray, then instead of this sort of asynchronous tag team effect, you have a synchronous wallop that pushes the Fed pivot even further out. So to me, it's very, very interesting because there are so many sort of every man for himself dynamics here, and OPEC Plus is now in the mosh pit.
So I want to bring an additional speaker on here, guys, before I bring him on, and that speaker is Michael Howell, the CEO and founder of Cross Border Capital. I want to give Brent a chance just to comment on anything he wants, and then I can bring Michael on. And this is the thing. This is the second Spaces in a row where I find myself surrounded by Michaels, and I wonder if is it them or is it me? I'm not sure if I have too many Michaels in my life. But anyway, Brent, go ahead if you have anything that you want to say.
Well, I'm actually excited to hear what Michael Howell has to say because I love his work. The one thing I would say is I think everybody can now see in real time the fact that these green initiatives, we've had these announcements for the last, 3, 4, 5, 10 years of these green initiatives. They're going to completely change the entire energy system. And the problem is we've run into the wall before these new systems are up and running, right? And as a result, it's just too little too late on the green front. I would encourage everybody to think of that same thing in terms of dollars and de-dollarization. For 1, 2, 3, 5, 10 years, we've heard all these plans that there's going to be a competing currency system. There's going to be a competing payment system. There's going to be a new trade bloc. But I would tell people to consider what happens if it's too little too late. It's not that the desire's not there. It's not that the attempts aren't being made. But if you hit the wall before these systems are up and running, in the same way that Europe has hit the wall before their green projects are up and running, what happens to the price of the dollar? Just the same way as what's happening to the price of oil and gas. And again, there's a big difference between saying you're going to do something and actually being able to pull it off. So I'll leave it at that, and I'll pass the baton to Michael.
I also want to say this kind of highlights something that we talked about earlier, which is the move from unipolarity to a new system that has not come into being yet. It's not formed. We're in this period of undoing and then creating something new. And these initiatives are possible in a liberal world where you have a security guarantor. But in the world that we're moving into, national security comes front and center again. And that something, again, I don't want to put out too many thoughts here, but when Michael N. was talking, one of the things that came to mind for me is something that I've talked about on the show quite a bit on numerous occasions, which is that the European Union itself came into being in response to security concerns, a desire to tie the Germans into a European economy. It was the European coal and steel community. And I wonder whether or not the right framework to think about whether or not the euro and the European Union survives in the face of the challenges that we see today is one that puts economics first or one that puts national security first. Because I tend to think that so long as the United States continues to lead and is able to sustain its role as the leader of this alliance in NATO and in Asia, the European Union will stay together. And I want to actually point people on this Twitter space to one episode in particular, went back a couple of years with John Mearsheimer on Hidden Forces, where we talked about exactly this. It was about the power of nationalism and the coming apart of American hegemony and why nationalism trumps liberalism every single time. So, Michael Howell, why don't you jump in here? As I mentioned, Michael Howell is the CEO and founder of Cross Border Capital, which is a London-based independent research and investment company. Michael is also one of our regular contributors and researchers for Genius Tier members of Hidden Forces. So, Michael, why don't you share your thoughts? Tell us a little bit about where you're coming from on this.
Sure. Hi, everyone. Thanks, Demetri. Thanks for the introduction. I suppose all we need now is Michael Green to come on, and we've got 4 Michaels. So let's look forward to that. A few years ago, I wrote a book called Capital Wars, which essentially addressed the whole idea about the hegemony of the dollar and the challenge to that from China. And American hegemony is basically about currency imperialism. It gives America a great exorbitant privilege, as it was called. Other countries, Britain had that for 100 years through the 19th century. It's a great underpinning of power. And the US can't lose that, or it shouldn't lose that. But China is basically coming. Now, I think we've all got to distinguish between the use of a currency and the level of a currency, because the two things can be completely different. I happen to think that we're somewhere near the peak in the dollar at the moment, but I don't think we're near the peak in the use of the dollar. And I think that's the thing that is really sustained. Now, one of the things that my book addressed was the whole idea about the architecture, as Brent says. That's really important. It is probably 80% of the story here. And a lot of people talk about Bretton Woods 2, Bretton Woods 3, Bretton Woods 1. Actually, we've never left Bretton Woods 1. And if you look at Bretton Woods 1, what was it really about? It wasn't really about fixed exchange rates. That was, if you like, an accident that came out of the Bretton Woods Agreement. What Bretton Woods 1 was principally about was creating a system where you get the free flow of trade and ultimately capital, where the dollar was the centerpiece of those arrangements, where the IMF and the World Bank policed errant countries, and where the US military essentially backstopped the system. Now, if you look at what we've got today, that's exactly what we've got. There's been no change. We haven't got a Bretton Woods 2. We're not going to get a Bretton Woods 3 based on commodities, whatever people may say. It's basically about the role of the dollar. China is coming, and China's coming fast here. And what China basically is trying to do is to unseat the dollar, and they've been very explicit about doing that. And it's definitely what the US has to do to address this challenge. What China is doing, and there's the number of avenues it's pushing, a number of doors it's pushing at. But one of the most important is the whole idea about redenominating trade in dollars. In yuan. China is the world's biggest importer and exporter, but it basically is also, outside of America, the world's biggest dollar user. It re-exports dollars, and what it should be doing is exporting yuan, if that's in its long-term interests. And basically what China has done in the last few years is to set up swap lines around the region. I think there are 36 swap lines with other countries with their currencies into yuan. Now, the only reason that will be done, or is being done, is that China basically intends at some stage overnight to redenominate its trade in yuan, and basically try and kick the dollar out of its trade. Now, what we're moving to is a world which is basically segmented in two, or cleaved in half. You've got a free world, which was actually the Bretton Woods 1 world, which basically excluded the Soviet Union and it excluded China. Welcome to the new world, because that's pretty much where we are now. Russia is excluded, China is excluded, Iran is excluded, North Korea is excluded, etc. And basically, that is the challenge that America has to face. China's opened up its bond markets to try and get more capital. That's not a particular success at the moment. Capital is leaving China, and they're trying to embark on a digital initiative with a digital yuan that will allow peer-to-peer transfers. But again, America is still very much in the lead, despite what the SEC is doing to try and hamper US innovation. The second question is about the level of the dollar. And I think here is an interesting insight about the UK. Now, I went back and looked at the math of the UK fiscal situation, and there's been a lot of nonsense spoken about the UK, particularly in some of the liberal media in the last week or so. Basically, the situation is that if you look at the debt coverage of the UK fiscal situation, looking at, let's say, entitlement spending plus military expenditure relative to tax and then looking at that surplus against interest payments. Interest was covered before the budget in the UK 1.8 times, so it was 180% coverage. After the budget, and excluding the backtracking on these taxes, it was still 120%. Where is America now? Right now, America is at 80%. So currently, entitlement spending plus military, subtract taxes, does not cover the interest bill on US debt. There's a 20% shortfall, which means the US has to borrow. In 5 years' time, that 80% goes to 25%. So the US fiscal situation is deteriorating fast, which is basically something that could undermine the dollar. So one of the things we've got to keep sight of here is that, number one, the challenge from China, and number two, the challenge domestically in terms of the deterioration of US debt and the rise of entitlement spending, which kind of looks out of control in many ways. The US may be the dirtiest shirt in the room, but there's a lot of shirts coming, and some people are finding soap.
Michael, I have a question about this, and I'm not going to articulate it super well because I'm still, working on getting a coherent theory around it. But it seems to me that China disproportionately benefits from being plugged into the international trading system. It also depends on the U.S. export market and export markets in general in order to build up its capital base. And the other point I was going to make was I'm not entirely convinced, and there are many other reasons why people would be reticent to hold the yuan. I'm not entirely convinced that while the Chinese do want some of the benefits of being able to use their own currency, that they're willing to bear the costs of actually doing that. And so what do you think of that line of argument for why the Chinese and the Chinese yuan is not close to replacing the dollar anytime soon, and that doing so, I suppose, would lock it into a trading system that really sits outside of where the main value chains are created? Case in point, the semiconductor supply chain, where all the major, difficult, high-value processes of that chain happen outside of China, so that the U.S. and its allies can actually produce high-end semiconductors, whereas the Chinese would not be able to do that without being plugged into that system.
Yeah, I think those are all really good points, and I think if with hindsight being sort of 2020 vision, it was a mistake to let China into the World Trade Organization in 2001. And if you look at the dynamics since then, I think that's what's created the deflationary background in the West and the slow growth environment, and saddled us with a lot more debt. And if you look at how China has benefited from that stage, in year 2000, China basically was responsible for 6% of global liquidity. Currently, China accounts for over 30%. It's just overtaking the US. So in other words, China has got some huge benefits in terms of monetizing a lot of these surpluses that it enjoyed following entry into world trade. So I think that there is a clear benefit. I'm not too sure what the costs would be in that, but I think there are some clear benefits that China has got, particularly if it gets the yuan to become a major currency, and it's got a foothold in the international markets right now. So I would be, I'm still rapt of the view that China needs to be addressed here, or the Chinese problem needs to be addressed. Now, maybe the Russian, attack on Ukraine and the response to that is some way recognizing that there is a bigger problem out there with China. Maybe China is the end goal. And what I mean by that is coming back to this Bretton Woods I idea that backstopping the system is the US military. China needs to import a huge amount of oil. It can get that oil from the Gulf, which it's doing now, or it can get it from Russia, which is not doing, but it will do in an ideal world for China in the future. The problem with getting Middle Eastern oil or Gulf oil for China is that there's a long sea route back to China where the Chinese tankers are vulnerable to any attack. So in any military conflict, the supply chain that China would run a gauntlet basically through Southeast Asia. It would be very, very vulnerable. There would be nothing able to protect the Chinese convoys, and basically China doesn't have the naval strength yet to do that. It really depends on the US. Now, if China got its oil from Russia, there would be far, far less of a problem. It'd be more defendable. So I think ultimately, maybe a lot of this, or the subtext here, is that we want the Russian regime to fail, and that way it would thwart China's ambitions in the longer term. Now, that may be left field, but I think currencies are geopolitics.
Yeah, super. Go ahead. Yes, go, Mike.
I want to say that I tend to agree that there is a geopolitical aspect to what's happening in Russia. China, I think, is importing about 75% of its energy. So if you can control the energy sources that China is getting, definitely you can put some pressure on it. Regarding the Chinese yuan becoming a global reserve currency, in order to do that, it would have to open up its capital account and have its currency free float. Now, there's a problem there, which right now we can see it because China cannot raise rates right now because it's facing some real estate issues domestically, while the US is raising rates. So it's putting an extra pressure on China. But if China were to open up its capital account, if you look at, and I mentioned this, I've had this discussion with Michael Cow previously. If you look at M2 versus its FX reserves in China, you will see that the ratio is about 8%. So if it were the Chinese tigers, the Asian tigers in 87, the pegs broke when that number breached 25%. So now imagine with an 8% M2 to FX reserves and China opening its capital account, everyone with one will convert their money and leave, if at least most of them. So I don't think, even though China wants to make it a reserve currency, in order to make it an actual reserve currency, it will need to be able to be freely converted. And I'm not sure at this stage China can do that. So I just wanted to mention that to put it on note.
Can I ask Michael Howell a question?
Please do.
Michael, I thought your comments about China's sort of end game in setting up these swap blinds, I thought that was very, very interesting. The question is, what is the time frame involved? Because as Mike Nicolas said, I think that if they actually freely floated the yuan right now, it would have a 9 handle at least. So you could, what's the saying? You could lead a horse to water, but you can't make him drink. I don't see any foreign banks taking them up on their swap lines in the near future.
Yeah, I agree. I mean, I don't think that the yuan as a major threat to the dollar is coming in the near term. I'm absolutely one with you on that. But China, we know, plays the long game. But I think the other thing is, history is often a good teacher in these situations. And if you go back and take the UK example, and this is a slightly colourful one, but it's an interesting point, is that in 1897 in the UK, it was Queen Victoria's Diamond Jubilee. And to celebrate the Diamond Jubilee, they had a sail past of the British fleet, where she was allegedly watching and giving the salute. That fleet took 8 hours to pass by the Queen. It showed the power, the military power that the UK had in 1897, and that involved a fleet where no ships from Asia or India were included. It was purely the Atlantic and Mediterranean fleets. So that basically showed the if you like, the military prowess of the UK. Within 20 years, sterling had been eclipsed by the US dollar. Okay, so 20 years from now, the same could happen. And all I'm indicating is that basically, wars can happen. And what happened in World War I is that Britain basically suspended all overseas lending by UK banks. US banks muscled in. They developed a trade credit market, and that was the beginnings of dollar hegemony. The dollar went from nowhere to being the major reserve currency in foreign exchange reserves of major countries by 1921. In 1914, the Austro-Hungarian penga, what it was called, was used more widely than the US dollar was. That's how quickly these things can change.
Except the big wrinkle here is demographics, because if you believe Peter Zeihan's demographics, and it's hard to argue the math, by 2050 he thinks the Chinese population could be half of what it is today.
Oh, look, I'm not promoting China. I'm not, and I agree absolutely. These are big demographic challenges. China's not in a good place, that's for sure. But in terms of their motivation and what they're trying to do, this is clearly they're clearly trying to attack U.S. dollar hegemony in the Asian region. What they'd like to do is basically get the yuan used more widely. And I would suggest that if you go back and look at the period from 2016, after what is labeled the Shanghai Accord, when there was an attempt to get the dollar down among the G20 countries, from that time until March of this year, what you basically have seen, or what you saw, was unbelievable stability across the Asian units. Cross-currency volatility basically subsided. And that, I think, was most countries were targeting the yuan. And that clearly wasn't a healthy situation. But fortunately, that was broken in March, April of this year, where you started to see some big devaluations of other Asian currencies. Now, that may have been, if you like, a Trojan horse to try and destabilize the yuan, but it certainly worked, because the yuan is now, a much weaker currency.
I want to give Brent an opportunity to jump in here, because I know that Brent is going to have to leave soon, and of course Michael Nicolas is over, it's like 3 a.m. over there. So I just want to make sure everyone gets a chance to leave when they need to. Also, I want to say, if you're interested in the way that Michael Howell views the world, where he's coming from, like I've said, he's a really, 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 really smart guy and a contributor to our Genius tier. We're doing a live Q&A with him this Friday. So if you have any questions, or you want to, get a link to that, we can share one with you. You can just send me an email at info@hiddenforces.io. Just don't DM me. Brent, jump in here. Let us know some of your thoughts before you have to jump off.
Yeah, thanks, Demetri. And I'll say thank you to all the Michaels right now for joining me in this. And I want to say a big thank you to Michael Howell for jumping in, because I thought he did a masterful job of explaining Bretton Woods, the role of the United States, the role of the dollar, the role of the IMF, the role of the World Bank. I wish I could speak as eloquently, and I wish I could speak with an English accent. Unfortunately, you guys are stuck with a kid from the Midwest who talks about milkshakes. But what I would say, what I'd like to leave with is I would definitely recommend people read Michael's book, because it will give you, again, an understanding of kind of the framework of the world monetary system, the powers that be, so to speak. There's another book that I would encourage everybody to read, and it's called The Political Economy of International Relations, and it's by a guy named Robert Gilpin. And you should put it by your bed, because it is boring and it will put you to sleep, but it will also tell you how the world works and what are the institutions that run the world. And I think it's important to have those as a framework. And I'm going to make a couple points here, because then I've got to jump. And so I apologize for kind of monopolizing the time here, but just give me a minute or two. And I want to leave people with these thoughts. And that is, I don't know if I'm going to be right or not. I really don't. I'm not so arrogant as to think that I couldn't be wrong. But what I do know is I've put an incredible amount of work into this, and I've come to the following conclusions. One is that based on the design of the system, the dollar will be the last to fall. And it's just kind of built that way. So if we get into a death of fiat scenario, betting against the dollar is, in my opinion, a fool's game. Secondly, the dollar falling is not a problem. So if they go back to QE and they're able to get the dollar back to, 100, 95, even 90, that's going to extend the game. That's not going to bring the system to an end. That actually helps perpetuate the status quo as opposed to bringing it down. The third thing I'd say is there's nothing that the rest of the world can do to bring the dollar down that the Fed didn't try to do over the last 2 years. And there's nothing that they can do that would bring the dollar down more than what the Fed did. They can do things that would ultimately bring the system down, but in the short term, all that chaos would drive the dollar higher, in my opinion. The next thing I'd say is the dollar might fall from here. It's had a heck of a run, and I've never said it can go up in a straight line forever. I think this could actually play out over several years. We could have 1, 2, 3 more bouts of QE before this is all said and done. There's nothing that says this all has to play out in the next 3 to 6 months. It could easily take another 3 to 6 years. One thing I'd say is if the Fed pivots, again, that's just a temporary solution. It just kicks the can down the road and we end up right back where we are now, unless they completely change the system. And then I would say that, and I touched on this earlier, those who think that the U.S. will relinquish the global reserve currency because of some economic benefits, I would encourage you to take a look through a different lens. I don't think the dollar is necessarily viewed as an economic tool only. It is a power tool, and it is used to exert force as opposed to just make this profit or make that profit. And then the final thing I'm going to say is I know that in many cases and in many times and in many of the discussions I've had with people on this topic, it becomes very clear that my position is not necessarily liked because that's not what the other side wants to see happen. And it shouldn't be this way, and that it's an immoral system and all these different adjectives that you can put on it. And I just want to be clear that advocating for something is completely different than acknowledging something. I am not an advocate for the system. I just acknowledge that it exists, and I'm doing my best to kind of help everybody kind of see what's happening. Now, whether it actually plays out this way, I don't know. But so far, a lot of the things seem to be firing. And so if you have big bets against the dollar, I would encourage you just to at least think where you could potentially be wrong. I know I always think how I can potentially be wrong. And I've been proven wrong several times before, and I may be proven wrong again. But I would encourage you to look hard and deep and put your own desires aside and just look at the world as it actually is. And with that, unfortunately, I have to jump.
Well said, Brent. Anyone who hasn't heard Brent's appearance on Hidden Forces, that was episode 250. The title of that episode was The Revenge of the Dollar. So I strongly suggest listening to that episode, as well as our episodes with Michael Howell and a recent episode with Lev Menand on the shadow banking system, which also describes much of what we talked about today. Let's talk endgame here to end the space and kind of think about where all of this goes. Michael, Cal, why don't you take this first? Brent said he didn't talk about how it ends, but he did say that it's going to take a lot longer than folks think, that these types of unwindings and changes in the global monetary order take a very long time to work themselves out. I'm curious how you think this ends, and feel free to incorporate into that conversations about war and anything else.
So, I've used this analogy on another space before, but this whole notion that the global debt levels have to keep rising forever, and there's no way out of that loop. To me, that reminds me of the Tacoma Narrows Bridge, which was a bridge that many physics professors use to highlight the physical concept of resonance. Resonance is a positive feedback loop in physics where, if the breeze starts swaying the bridge to its natural harmonic, that it creates a self-reinforcing positive feedback loop, and the oscillations get larger and larger until it exceeds the physical capacity of the bridge and the entire thing crashes. So the financial equivalent of that would be a complete system meltdown where the oscillations and the debt levels just get so large that eventually the entire system breaks, right? Which is kind of what you saw during like the Weimar hyperinflation. So today I had an interesting discussion on my feed. I said, here's a thought experiment. Let's say the BOJ bought up 100% of its outstanding JGBs and then just canceled all the debt. What happens to the JPY? What happens to the stock market? And, I got a number of different questions. But, I guess in a perfect, my thoughts on that end game are that, well, in a perfect world where they no longer need access to global markets, then maybe nothing happens. Maybe the yen actually appreciates. But to me, that's a very unlikely scenario. To me, it's very unlikely that there is such a thing as a free lunch and a perpetual motion machine, because if you're a country that has been profligate enough in its spending ways to have gotten to the point where you need to do yield curve control to the point where your central bank owns, a significant portion of all debt outstanding, then the world is going to view your currency as trash. And so I mentioned at the outset, so I spent much of my career in corporate bankruptcies and restructurings. And so the thought that I want to kind of throw to the panel is, what is the sovereign analog to a corporate restructuring? What is the sovereign analog to a post-reorg equity where debt gets canceled, right? If debt gets so large that the debtor can no longer afford the interest payments, right? There's something called a bankruptcy process that cancels the debt, and the debt gets restructured into post-reorg equity, right? So here, I'll start by just saying my own thoughts, and then I would love to hear the panel's points of view on this. Here is where I feel that even if it came to that, the U.S. once again stands at the top of the heap, because it comes down to what is on the left side of the national balance sheet. Because if you're talking about an endgame scenario where debt has to be restructured into some sort of sovereign post-reorg equity, well, then those equity claims are going to be based upon what the country owns as assets. What are its natural resources? What are its gold reserves? What's its ability to just create economic rents? So I don't know how the end game, if that is really the end game, that there is an endlessly bigger, sort of amounts of debt, then that has to be the end game, right? But the alternative is, and I think that there's no better way to, or there's no better excuse to try to put in to sort of dampen the oscillations in that mental model than 9% or 10% inflation. Sooner or later, you have to acknowledge that there is something called a business cycle, and that austerity actually may have to come to pass, and national balance sheets need to be shrunken one way or the other. So those are my thoughts as to endgame. I would love to hear the panel's thoughts.
So whichever Michael wants to go next, feel free to unmute yourself and take a stab at it.
Okay. Well, hearing your question, I wish I was Michael J. Fox in Back to the Future and having the almanac to give that answer. It's one of the hardest questions I get to think about, because there are so many variables here that if one of them changes, for example, the war ends or the dollar gets stronger, where it changes the whole story.
I don't mean to, and by the way, that you're totally right. So like 100%, in some ways, these are ridiculous questions to ask. So feel free to answer it however you want, Mike.
No. I'm putting it out there the way I'm trying to think about it, because
sure.
Yeah, I believe me. I think anyone who runs money or who looks at markets thinks this question over and over and over, and tries to figure out what's going to happen. Again, I don't think there is an end game in the sense that there is an end game, because it's an ongoing process that never ends when we talk about market.
Well, what do you think happens to Europe? That was something that we were talking about earlier. What's your view? Does the EU stay together? Incorporate that into your answer.
No. I think that the euro is the probabilities of the euro lasting as it is are very small. And why do I say that? Because in order for a currency block to work, interests need to be aligned. And I don't see how interests will be aligned going forward. So I think as the years pass, the frictions get stronger and stronger, and at some point something breaks. I don't know if it breaks, let's say, in a controlled manner, being that one day 19 countries decide altogether to go back to their currencies with a peg and steadily, go back to their currencies free floating while keeping, let's say, all the EU benefits. That could be one scenario, or it could be one country deciding to leave because it had enough and it doesn't, and it can't take it anymore. I don't know what that is, but I can't see the euro lasting as it is past 2030. I would say I would put 2030 because it's 30 years since it started. So I think frictions will increase, and there's a famous quote by Henry Kissinger when he said, "When I call Europe, who do I call?" And that embeds actually the answer. Who do you call when you call Europe? Who is Europe? It used to be Germany. It used to be Angela Merkel. Now who is it? Macron. It's not a clear answer. So I think unless this question is resolved and resolved clearly, Europe, it will be very hard for Europe for the euro to last. So I think this is a main challenge, a very big challenge. The other challenge that is out there is, as Michael Cow said, it's the debt. What happens to the debt? What happens to the BOJ, for example? Do they cancel their debt? Or do they do, the Treasury Secretary gets with the central banker and says, "Hey, man, how much do I owe you? You owe me XYZ. Okay, let's do a swap and issue a 100-year bond at 1%. And, that debt goes 100 years out." That could be a scenario. What happens to the yen then? Does it rally or does it fall? It's a hard question. What I can say with a strong conviction is that the two things that will be the most important things in the next couple of months and years is liquidity risk. People need to focus more on liquidity risk because when there's no liquidity, a lot of things go bad. So you need to focus on that. And the second thing that a lot of investors will need to start paying attention to, which they haven't been for a long time, is counterparty risk, which everyone thinks that their counterparty is safe. But assets with no counterparty risk, I think in the next few years, will deserve a premium. So I think that's something to pay attention to. So I think this is where people should focus. I do believe that the dollar gets stronger. I don't believe it gets stronger in a straight line. So I think we haven't seen the end of this move. Probably it goes back and then it goes back higher. And I think that if something breaks and the Fed pivots, as Michael Cow said earlier, then commodities shoot to the moon, and then we go back to square one, and inflation goes back up. And I heard Mohamed El-Arian's interview a few days ago, where he suggested that we might be entering a period where the Fed goes back and forth, where it pivots with rate hikes, and then it pivots with rate cuts, and then it's forced back to rate hikes. So this could be a scenario which has been in my mind for some time now. But I would focus on liquidity risk and on counterparty risk, and I would be very patient and very prudent because I think volatility is here to stay and it's likely to increase. And, in 2008, all the debt from the banks went to the government, and now the government, we're seeing the government experiencing issues which are seen in their currencies. So I think people need to be very careful. And if I were an investor running other people's money, because I'm not right now, I would reduce my exposure and I'd be having a low gross exposure just to be safe, because I think we haven't seen the end of it. This is the end of the beginning, as Brent likes to say. So let's be patient and wait it out. That's my 2 cents.
Michael, you and the other Michael Cow, are both two people who haven't been and need to come on Hidden Forces both individually. So we're going to have to make that happen at some point, and we'll have a chance to dig into your views about markets in the world more deeply. But great analysis. Thank you. Michael H., why don't you give us your view, whatever it is, again, like very impossible question to answer. So take a stab at it however you like.
Yeah, I think the big issue is liquidity risk. I mean, that's what we see. And, my simple take on what policy was this year was that US policy was pretty much about getting the Fed balance sheet down and getting the US dollar up. I think policy in 23 is going to be about getting the balance sheet up and the US dollar down. And I think because the reason for that is the Fed is going to break something. And I think things are breaking fast. If you look at the ISM survey today, you look at the internals on that, it looked really quite bad, in my view. So the economy is definitely weakening a lot. And, if you think the US economy is weakening, just look outside of the US, it's a lot worse out there. So we're looking at world recession. Look at what FedEx announced 10 days ago. If you extrapolate FedEx's announcement, it's telling you pretty much that world trade is going to be down 30%. That's what it's consistent with. So the outlook is not great. What are they going to do? My view is that, and I think that was largely underscored by what the Bank of England did last week. The alacrity with which they moved suggested that yield curve control is coming back, and yield curve control is something that we've seen in Japan, we've seen in Australia. The US did it between 1942 and 1951 pretty successfully. Generally. Interestingly, I looked today at previous FOMC statements about yield curve control, and to my great surprise, I discovered that Lael Brainard and Janet Yellen, when she was chair, were big advocates of yield curve control. And the endorsement on yield curve control came from a paper by the St. Louis Fed that basically said, it's had great success. So I think that's the way that policymakers move. And although I see, the sort of illogic, if you like, of printing money or whatever, I just think that what policymakers are going to do is kick the can down the road. And is that a 10-year road, a 20-year road, a 30-year road? I don't know. But I think it's in most of our lifetimes that they're just going to keep kicking the can down the road. And we suffer the consequences, but ultimately the consequences seem to be some form of asset market inflation. What that does is it creates a huge skew in society. It disadvantages a huge amount of people, but for the moment that's the world we're living in, and I don't really see there's any alternative or anybody who's coming up with an alternative, sadly, perhaps.
Well said, Michael. Again, if anyone wants to join our live Q&A with Michael this Friday, where we also take audience questions as part of our Genius tier, you can either subscribe to our Genius tier at hiddenforces.io/subscribe, or if you want to try it out, you just want to see what the live is like, shoot me an email at info@hiddenforces.io, and my team can send you guys a link. This was awesome, guys. I've really enjoyed doing these live spaces. I'm going to republish this on the Hidden Forces feed. And of course, the audio remains on Twitter as well for anyone that wants to listen to it. But our main guests were also recording locally on their microphones. So in certain cases where you heard Brent break up, or I don't know that it happened that often to Cow, that you'll be able to hear it because we have that original recording. Again, thanks so much. And I hope everyone has a great night.
Thank you very much for having us. It was a great discussion.
Thank you, Demetri. Thanks, everybody.
For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to full episodes, transcripts, and intelligence reports, which include additional notes, resources, links, and other material that will help you get the most out of each and every episode, check out our premium subscription, available through the Hidden Forces website at hiddenforces.io/subscribe. Today's episode was produced by me and edited by Stylianos Nicolau. For more episodes, you can check out our website at hiddenforces.io. Join the conversation on Twitter at HiddenForcesPod, or send me an email at info@hiddenforces.io. As always, thanks for listening. We'll see you next time.